Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the markets closely related that may even impact the precious metals markets. And Miles, last week with Rob on the show, who's not here today, unfortunately, we did have the discussion about gold potentially coming down to that 1,910 figure that we were hoping for, and we got our wish and some. So kind of a fun day to be doing a recording with the price action in gold. You want to kind of start there and tell us where we're headed with your crystal ball?
Sure. So let's go back to June when that happened. One of the reasons we're pegging that is just a very simple Fibonacci retracement, nothing overly complicated there. So it was good to see a nice little bounce there. And one of the arguments we were making back then, which now was about a month or so ago, was we expected, because of some of the seasonal pressures on metals, we would see gold probably trickle down to the 200-day moving average. We'd probably see the same from silver, trickle out over to its rising trend line, which we'll look at here in a minute. Lo and behold, it turns out that's exactly what we did a month later. However, we had this little thing that happened in between, and we had a pretty strong bounce off that 382 fib. In fact, we came all the way up to a breakout level on the upside.
Almost through the ceiling.
Gold. Yeah. And I remember sitting in here, I think Rob was here that week, and I remember sitting in here and saying, Rob, it's at that 1980, and if we're above 1980 in the next day or two, we're going to the old highs, because there's nothing in between the two. And here we are right back to where we initially thought it was. So one of the things that we've always joked about, I've certainly always joked about, is markets are going to do what they're going to do according to the trend. And the trend, arguably, for the summer is you tend to see these things kind of correct back down from their spring highs and trickle out and build new bases and provide new entry opportunity and so on and so forth. But the short-term events are going to cause that to have speed bumps, or it's going to speed things up, slow things down, so on and so forth. Now, granted, we'll talk a little bit about what if we have some breakouts to the downside here. So we will address that here in a second. But before we do that, I look at this from the standpoint of, okay, if we go back to June and we say, hey, we might trickle all the way down to the next Fibonacci level, down where the 200-day moving average is at that point, well, we're down in the 1860s. Mm-hmm. However, because we had this little bump up and back down, that's pulled everything up. So it's possible, I'm not saying likely, but it's certainly possible that because of that little bump up in the market, we could get a double bottom here at 1895, which I think was the intraday low back in June.
That's what I recall as well. Yep.
So even though we're down, we're still technically not at a new low yet this summer. Maybe by the time we go, we publish tomorrow.
Yeah, that's right.
But technically, we're still not at a new low yet, and we could get a little bit of a turnaround because we hit the 382 again today, and we hit the 200-day moving average, which is now $30-40 higher than it was a month ago.
That's right. Yeah, it's, again, a welcome opportunity. All of these dips, when you're cost averaging in and you're buying on a monthly basis, or you're holding out looking for good opportunity, these are opportunities to step in and add to your ounces. And then we look at things like the ratio in order to determine, are the white metals equally at a good value? We're always seeking value. How many ounces for the dollar can you get, especially in a short-term dollar rally? So let's get a little bit into silver. Let's get a little into the dollar, because we like to measure gold relative to other things.
Yeah, and I know we were talking right before we started recording, but I think the charts to look at today are the dollar and the Dow. I think those are key things we're going to want to get to. So yeah, let's keep going through the metals, transitioning over to silver. Same kind of story. The argument was, if you look at the silver chart here, we've had this long-term rising channel, which started back in August of 2022 on the downside, and we've had these big swings up and down. You're talking like $5 moves in silver. Silver's been incredibly volatile for the last year. And when we hit this bottom back in June, I thought we would trickle all the way back down to this rising trend line, which is going to put us all the way down at around 21. But because of this bump we had over the last month, we still may come down to that trend line, but now the trend line's at 22.
Yes.
So everything's starting to shift upwards in silver when you look at these retracement values. And the opportunities, even though you're getting the rises and then the returns back down, each time you take a step down, you're one stair step higher than you were 2 months ago.
I love it because a month ago you laid out the chart and you tried to be a little predictive on that most recent low. It was a higher low, but you even shaded the area in and said you wouldn't be surprised if we didn't spend some time in this area. And guess where that was? That was right where we are today, 2250. We could certainly trade sideways here for a bit and in this range of this rising trend line. And again, those serve as great opportunities. It's also an opportunity to watch and see what happens. If you get a bounce, you jump in. Or if it breaks through that, then we're going to have all eyes on you and all ears on you for you to tell us where it's going to go next.
Sure.
But to come back down to the other lows, again, that doesn't interrupt the bull market, right?
Yeah, what can I say? I'm that machine from that movie Big. You put a quarter in, it gives you that little card with your fortune on it. I'm about as accurate as that. So since you brought it up, what are some downside targets? Let's say we do have an abnormal summer to where gold moving into the fall, silver moving into the fall does continue to decline, which doesn't happen often, but it has happened a handful out of the last 10 or 15
happened last year.
months.
Our low wasn't put in until October of last year.
Right.
So September and October were down months after somewhat of a weaker summer.
Yeah, so you could be looking at $20 silver again, which is a way better chance than the last time to buy into, say, something like Silver American Eagles, which are a lot better priced than they were 6 months ago with the premiums coming back down.
Yes, it's night and day. August of 2023 is completely different than August of 2022, even if the spot price is the same, because the premiums have softened so much. Like we said last week, it's an additional 10 to 20% discount on silver.
Right.
And we may go down to meet those highs from last year, but for now, we're up well over 10% from last fall, and we're up well more than $200 in gold in terms of silver and gold respectively. We'll take that all day long. People are saying, why aren't gold and silver doing more? That's a great year. That's a great year over year in terms of where we are versus this time last year, especially when you look at what has transpired too with that dollar. And I know you want to talk a little bit about the US dollar in the chart, but before we leave silver, it has given us an opportunity with ratio too. So the premiums have shrunk and the ratio has climbed. So it's another red flag saying, look, don't ignore silver here as a great opportunity. At some point it will outperform. It's at a great value. And you have this fascinating chart on what that gold silver ratio trend line is doing and how that's forming.
Yeah, the gold-silver ratio chart is great right now because we've been trading kind of equidistance, maybe favoring the under versus over side of the 200-day moving average. And we've been building this great little sideways, what we call a pennant pattern, a sideways triangle, compression zone, whatever terminology you want to use. I like compression zone. But we've been compressing to a point here at that 200-day moving average, which is probably going to play out in the next month or so. Regardless of what the dollar price of gold and silver end up doing, we are going to have a shift in the relationship between gold and silver, ounce to ounce. It is coming in the next month or two. I don't know which direction. I think, as I tend to do, I tend to favor the trend. I think the trend generally wins in most cases. And guess what? The trend is down in the ratio. So there is a good opportunity here, especially if we see silver trickle out over the next couple weeks, to increase your silver positions at an 85-to-1 ratio and be looking maybe sometime next spring. Again, I hate pulling my crystal ball out. Tori, I know you get real concerned when I get optimistic because I'm never optimistic. But pulling the crystal ball out here, if this plays out the way it seems to be stepping up to, regardless of what the dollar price does, I think we might have a gold-silver ratio in the next couple of months.
May it be. I would love to see that trend break down and just that ratio really have an accelerated shrinking effect and give us a 20-30% gain in ounces.
Yeah, it doesn't have to be 100% gain.
No, not at all. We'll take the wins as they present themselves. So what about other metals? And then ultimately, I can't forget to put you on the spot with the dollar.
So just because we haven't been on a regular basis, I think it is worth bringing up the dark horse in my personal comic book collection, platinum. Platinum is well below the 200-day moving average. We did break below about the deepest correction level you end up looking at, the 786. There actually is an even lower Fibonacci number below that, but I tend to never even draw them on charts. So we have put in consecutive lower lows. We're significantly below the 200-day moving average. I actually wouldn't be surprised to see a platinum jump here, but not necessarily a trend change. But just from a charting perspective, I wouldn't be surprised to see a platinum jump up here just to kind of shake off some of the selling cobwebs and show a little bit of momentum. But yeah, from a fundamental geopolitical standpoint, I'm done trying to figure out platinum.
Well, I think we're all done trying to figure out the geopolitical landscape, whether it's to predict the platinum price or not. It's a lot of unknowns out there, and platinum to me is still 10% of my precious metals portfolios. When we have a blank slate and starting from scratch, whether it's in an IRA, less so for possession, but certainly storage accounts. So don't get discouraged by platinum. At some point, someday, it's going to be the leader.
Right. And that's why we encourage, especially with retirement accounts, where you've got your tax advantage there. Mm-hmm. That's why a lot of our IRA clients have not massive, but at least some platinum exposure. It certainly worked out for the guys 10 years ago that did 5 or 10% in palladium. It took some time, but I don't have anybody that bought palladium in 2012 that wasn't ecstatic 8-10 years later.
That's right.
So we could be looking at the same thing there. So dollar. Dollar did two great things today. We had this nice rebound in the dollar, which wasn't surprising. They raised interest rates. You want the dollar to go up when they raise interest rates. It's real scary when they raise interest rates and the dollar goes down, because then Europe and China and Japan, and nobody has any appetite for it. So I was glad to see that. However, dollar hit the top end of its declining trend line, and it hit the 200-day moving average today. I bet the dollar goes down a little bit over the next couple days.
Well, that would coincide, as the Fed comes out and is making this decision in September as to whether or not they're going to hike rates again. It looks like they probably won't. It'll be either the pause, it will be the term, or the skip. They're talking about another 25 basis point hike once or twice this year. If they don't, then that would coincide with that dollar decline if they pause or they skip. But quite honestly, Fed Governor Kashkari came out and said, the rate hikes have already slowed the economy, so they have to be careful there. They know that's what's going on, but they want to see convincing evidence that inflation's going to 2%. They feel like it's moving in the right direction, but they're not ready to say that they're done raising rates. But just the pause or the skip, to me, would coincide with a little bit of upside resistance in the U.S. dollar index, a turn down in the dollar, a floor in the gold price, and that hopefully this 1860 to 1895 holds as the ultimate floor before we get this next bounce. Again, total conjecture, but I'm just operating off of what they're saying. And for me, there's a boiling of underlying fundamentals. I talked a lot about them on last week's show, but we've got a September 30th deadline for funding the government. Like, here we go again. We're going to have political theater, but debt's going to continue. It's going to continue to increase. More U.S. debt is coming. And if they go to force a government shutdown for political purposes right at the end of a fiscal year for the government, that'll cause enough fireworks to pop gold $50. China doing anything with Taiwan, $50 to $100 pop in gold. Increased tension with NATO and Russia, any number of triggers there, pun intended, would pop gold $50 to $100. But what else could cause the dollar to turn down? Like, we have to keep our eye on those things too. And some of it can be the banking system. We spoke a lot about that last week, but Fitch now, so we already had Moody's come out and downgrade some banks. Fitch downgraded the U.S. credit rating. And now Fitch is saying that it may be forced to downgrade dozens of banks, including JP Morgan Chase. Well, why wouldn't they? Miles, like we talked about, money is leaving, capital and deposits are leaving banks, and it puts banks in precarious situations where they lend out based on deposits on account, and they invest their assets accordingly, especially into longer term fixed interest stuff, which is what got these other banks in trouble earlier in the year. And this is nothing. Fitch and Moody's, try Weiss Ratings. They've downgraded hundreds of banks this quarter. This is a systemic problem that's far greater. And you want to watch the dollar turn down, start to recreate the great financial crisis from 2008.
Right. Well, I think about a bank rating I gave to a client yesterday who's looking at a local credit union there in the state of Michigan going from an A+ to a C+ in a single quarter. And I'm looking at this, and normally it's like, okay, We do a bank rating for SVB this spring. Pretty easy to figure out. We look at their asset mix, 50% invested in the equities market. The equities market just took a dive. Obvious. Or you look at another bank, they're 50-60% in consumer lending or commercial real estate or something like that we know we're having problems in, and you look at their loan to income ratios and they're facing these massive debt charge-off. Okay, that makes sense. But I look at this credit union, it's like the loan book looks good, they don't have a lot in the stock market, their consumer lending position is small. Why the heck did they lose 2 letter grades? And they've been an A+ for 10 years. Like, how does that happen in a quarter? And I think you nailed it. It's flight capital.
Yeah.
Why would you keep money in a bank CD paying 2-3% when you can just go buy a Treasury bill for 5 or more?
Yeah. And not even a bank CD. How about just in a checking account where it's returning 0? Of course, people are going to go deploy those assets and try to get yield. Technically, it is a run on the bank. It's not what we have been taught is a run on the bank, where people don't distrust the banking system and so they pull their deposits. It's that they are seeking yield. And why? Because inflation is so high. I gave a bank rating to a poor 86-year-old widow client of mine, and it breaks my heart because she is suffering. Her income is fixed, and she is now reverting to fast food because she can't afford to eat anything else. Her electric bill, her water bill, her property taxes, her gasoline, everything has gone so high, pinching her monthly budget. Well, guess what? Gold offsets all that. So if your savings is in physical gold, it's not a perfect recipe. It's not minute by minute that it's going to offset it. But with your cash robbing you at a legitimate 10 to 12% is the real inflation rate, and everybody feels it. Their budget has been hit 10% from this time last year. And that's unaffordable for somebody that's no longer working, can't go get a second job, can't replace that loss of purchasing power. And that's unfortunately exactly what gold does best.
Well, does it not surprise you that over the last couple weeks, even when we look at our long-term clients who have been consistent gold accumulators for years, does it not surprise you that when you take something like, say, our vaulted program, which isn't a gold alternative, it's a bank alternative for long-term savings accounts, and the amount of additional funds that we've seen come into the vaulted program over the last couple weeks, that's not money that was going into gold coins. That's money that's been sitting in a savings account.
That's right.
For the last year.
Yeah, because it has the lowest margins and it's the cheapest gold in the world when you take everything into account.
Right.
And that's also what people need is everybody's looking to pinch margins right now.
Yeah, so it's people chasing Treasury bill returns, which I think is completely reasonable, or looking at programs like Vaulted, which offer a low-cost alternative to a savings account at a bank. So I think you're right. It's heartbreaking for me to see liquid capital institutions like banks and even credit unions, which are less nefarious than the banking industry because they just don't have access to the same investment markets.
And increased accountability with their membership.
And the liquidity is just going through the floor. So money is moving. I don't know if all of our listeners are also in the process of moving money. I don't know what the psychology behind it is that's causing this mass shift. Weiss downgrading 1,000 banks or something like that. Moody's downgrading across the board.
Wait to see what happens on an international level, right? It's happening domestically with our banks. What happens with the U.S. dollar? We were just talking about the dollar turning down. We may have some comments coming out of the BRICS summit next week.
I was just about to say, we haven't even mentioned BRICS yet.
No. What sort of currency agreement do they come out of there with, with their new development bank, they're calling it, and wanting to lend in local currencies instead of the U.S. dollar? That can absolutely cause a repatriation, in a sense, of U.S. dollars, a lower use of the U.S. dollar on the international scene, and a dollar index drop. It would bolster local currencies, other currencies in the dollar index basket, and that could correspond with our fall rally that we typically see in gold.
So everything's coming to a head right when it generally does. That's going to do it this week for Golden Rule Radio. As always, we appreciate you stopping by. If you have any questions, would like to discuss the health, credit, safety rating of your bank, or anything else precious metals or market related, give Tori, myself, or anyone else here at McIlvaney Precious Metals a call. We can be reached at 800-525-9555. 56. Make sure to catch our other weekly market pieces from the commentary to written articles on our website at McIlvaney.com. You can find us on Twitter, we're at ICA Gold, or on Facebook at McIlvaney Financial. Thanks again for listening and have a great week.